We've got Peter Mcguire joining us this morning. Peter, thanks for being with us on the show. Let's just get your sense of what's really happening. What's causing this optimism, given that we're still waiting for that Fed hike? Markets seem to be on a bit of a roll.
Yes, good morning, and thanks for inviting me on the show. Yeah, I just think over the last couple of days we've just seen a little bit more confidence from certainly the US. Some of those numbers are a bit more bullish. You've got a rise in crude, sell-off in gold, currencies, and of course, I think momentum and a general feel-good factor has underpinned the market. And that's been very evident. Your previous guest was on, and what's happened with the commodity complex over the last 72 hours or so. So it's certainly a little bit stronger. What happens over the next couple of weeks will be interesting. But yeah, crude touching nearly $50 a barrel certainly has taken those fears as far as deflation out of the picture.
Morning, Peter. One of the things when you look around global markets, it seems even small amounts of money seem to move the market one way or the other. So is the market really run by because of enthusiasm for stocks or enthusiasm for commodities, or it's just that there is just overall disinterest? So even small amounts are moving the markets this way or the other.
Yeah, I think. It's a good point. I mean, sometimes that can certainly look like the case. And where it's at the moment, that underlying confidence, that's what sways a market. Traders don't sell, they buy. And, of course, that's very evident with what's happening at the present time. And the general feel-good as far as what's happening, with Yellen, and a very big case that you may see that rate rise next month, that all underpins confidence. And as we all know, we've all been in these markets for a long, long time. Confidence is a big, big thing. When it's very hard to determine what dollar value it's worth, but if confidence is going your side, it underpins and it forces things higher, and that's been the state of play over the last week or so.
Okay, what about the dollar as well, Peter? Because that's the other element that we're keeping an eye on. We've also got that impact coming in on the yield front as well, Treasury yields. Where do you see that headed? How much more strength and the kind of implications you see of that on emerging markets?
Yeah, sure. Well, I mean, where the dollar is at the moment, I think it'll probably trend higher. We've seen what's happened with gold, and I think that'll be very evident over the next matter of weeks. If I'm saying probably up 1 or 2% against emerging markets, and of course against the yen, and then what happens, against the the US dollar index against the euro and so on. The unknown there, of course, is what's happening with Brexit. But I think the overall picture is that England will probably stay in the EU, and I think from where we're sitting, it could be a bullish summer for US dollar. Over the next month or two. So if we do have one rate rise next month, as they said in December last year, we wouldn't be surprised to see 3 or 4 in the 2016 calendar year. Well, that will certainly again underpin the US dollar.
Peter, just coming to oil, one of the issues about us getting oil wrong is because of how the index is set up. I mean, North Sea, I don't know who drills oil in North Sea now. I mean, maybe some people do. And this whole Brent business. Because if you go to a South Sudan, or if you go to, let's say, even Saudi Arabia or Iran, I mean, they're desperate to sell oil. Maybe they're not part of the benchmark, but they're desperate. And many of their prices, the spread between Brent and what these guys are charging is really increasing. Peter, could you really speak about actual demand and supply for oil? Because the world seems to be awash with oil. We can find some Alberta fire to say oil is less, but it's awash with oil otherwise. And tons of very poor countries just desperate to sell this to run their countries.
Well, exactly right. I mean, and even the rich countries. Think about what Russia's experiencing. Second largest producer. Have a look at the likes of Venezuela and, of course, Nigeria. And then run your eye across, the Middle East and Iran and so on. So they've all got very damaged or to some point it's an implosion of their balance sheets over the last, say, 12 to 18 months. And if you look at the likes of, sanctions being lifted and what Iran's going through, and Nick wants to, desperately try and raise its output. The world is awash with oil. And all of these factors going in, the likes of Saudis, pumping as much as they physically can. So it's just it's a bit of a wait and see. I think that what you'll see over the next, 3 to 6 months, if oil goes higher, and you take it, say WTI and Brent is sitting at 55, then what's going to happen to the US producers? And I'm sure that when you see the rig count, it'll start to ratchet up very, very quickly. If these guys it's costing them 46 or 48 bucks to pull it out of the ground in the Gulf, they'll be at it, and the shale producers, everyone will, ratchet back up, and that's going to greatly impact from a demand side because there'll even be more supply out there. So it's not a great time to be a driller of oil at 40 to 50 bucks a barrel, but we'll have to wait and see what happens at 60.
Peter, what's your call on Asian stock markets? When you look at money flows seem to be getting out of global stock funds, emerging market funds going out. Then who's financing these markets? Because, or are they just basically mirroring whatever is happening in the US? So if S&P rises, everybody says, well, we'll rise too. Is that how it's working, or do you think there's some conviction to drive these Asian markets?
Well, some of them have performed incredibly well. But yes, I think it's just, again, the confidence. What happens? I mean, it's all tied. When you examine it, you've got to say that we've had a big run-up as far as energy prices, and that's underpinning. And then you've seen what's happened as far as the S&P, and then that raises all boats. And I think that's where it's at the moment. The fear is, I'm not saying the fear's gone out of China, but certainly it's not front page like it was, going back earlier in the year. There seems to be a bit better feel as far as confidence, again, as far as the Chinese numbers. But that can change quickly. There's still a great degree of unknown. So at the present, I'd have to say that, yes, the S&P and the mighty Dow are carrying a lot of boats higher, and on the back, of course, of the energy prices.
Okay. Peter, what about Asia? We've got, Asian screens a little quiet this morning compared to what we're seeing in the rest of the world. We haven't yet had any hiccups from China. Japan seems to be somehow soldiering through, the recent data suggests. So, what are you making of the kind of risk factors we could still see from that front?
Well, there's always the unknown as far as China, and I think that, at the present, there's so many different angles to trade the market. The volatility, and then you're looking at, short-term traders, their views on markets, and then you've got longer term, and everyone has a different risk profile, and of course, what they're after as far as, an horizon. Some people want to be in a market for a matter of minutes, hours, days or trading sessions, and then, a longer-term view. So at the present, certainly pension funds, you're looking at, and that grows weekly with, salaries and how people have to invest in funds globally. So that always underpins markets, more buyers. And then you're looking at, the performance of stocks like Japan. The Nikkei's had a bit of a correction, and possibly where it sits, they may have a stronger Japanese summer. And it's wait and see what happens with the Asian markets. But, there's still that level of unknown out there, and I think it's going to be a very interesting 3 to 4 months. Unknown as far as politically in the States, what happens with the email situation with the Clintons, and then, of course, Mr. Trump and Brexit. So they're just two major issues, and they can quickly change a market. And then you're looking at Yellen, what she does with rates, and, of course, the energy sector, which is global. So I will say, the gold market's had a nice correction to the downside. And where that sits over the weeks ahead, it's a hard one to speculate on.
So, Peter, just going beyond, today, tomorrow, maybe a month, are we pretty much in Jungle Book because Mowgli hasn't been caught by Shere Khan? Everybody thinks things are fine. I mean, China still's around. Some days we get very excited about China. Some days we think it's going to just collapse. Are we just letting or is the market really running more on virtual reality, so to speak, than the real situation on the ground?
Yeah, I think it is on virtual reality. I mean, it's hard to trust the numbers coming out of China. No one can. And as you correctly said, you know, it's not a minute-by-minute proposition, but certainly a weekly proposition. What's the general feel-good factor coming out of China? Is, you know, the numbers disappointing, or are they're okay for the last couple of days? And that's the great unknown. You've got a lot of large money managers and bondholders, and all these guys are very negative on the China situation, and it's hard to put that out of your mind. So if we do see it, you know, it has a hiccup again and does have a washout, I think there's a lot of traders out there that wouldn't be surprised. And will it be a contagion across other Asian and emerging market economies? And you'd probably have to say yes. So that's the issue at hand. And a lot of people still say that we're not out of the woods as far as the GFC. So it's a hard one to speculate on, with, you know, some countries with negative rates, as we know, and then, you know, the US wanting to, you know, put them up a fraction. So it's not a normal trading environment. These aren't normal times.
So in that context, Peter, the kind of rally we've seen the last 2 days, even on the US equities, do you really see that sustaining, or do you expect a lot of volatility going ahead?
Yeah, I think I think the vol will stay. The volatility, I don't think, will go away, and I think it'll probably run more volatile over the coming months, because you've got these unknowns. You've got what's happening as far as rates, what's happening with Brexit, an election, you know, and will Trump get in? Where are the Chinese numbers? What's happening with energy prices? I mean, you could have been sitting here 6 weeks ago and said, you know, there's every chance that crude could be back at 30, and here we are just on 50. So, you know, everything is incredibly volatile, and the mood can change, and that's why that confidence, we spoke, you know, a couple of minutes ago, confidence changes momentum, and all you've got to do is get a series of bad numbers, and all of a sudden you could have crude back at 40. Or you get some good numbers and crude could be sitting at 52, 53. But I think that it's exhausted a little bit to the upside, the crude market, and I think that's going to be the barometer that we all have to sit at and have a closer look on, you know, as the months roll forward.